It is now time to listen and learn about government securities, valuation, and trading. Our resource speaker for today is someone you're very much familiar with already, Mr. Clive Wee Sit, Vice President and Head of the Portfolio Management of Fixed Income Team of the BPI Global Markets segment. Welcome, Clive.
Thank you for that wonderful introduction, Gams. Okay, so I'll share my screen now. Okay. So good afternoon, everybody. My name is Clive Wee Sit, and I am from the Bank of the Philippine Islands. Today's lecture will cover government securities valuation and trading. So before we begin, let me share with you some of the expected learning outcomes from this lecture. By the end of this course, you should be able to know how to value a bond using a discounted cash flow methodology. Many financial assets, such as fixed income, equities, as well as derivatives, use some sort of a mathematical present value approach to determining value. So it's important to know the steps in doing asset valuation. The next is we will calculate how to get the settlement amount as well as the clean price of a government security. Now, by settlement amount, what we mean is how much cash is actually paid for a government security that is acquired. Clean price, on the other hand, means what is the peso value equivalent of the government securities yield to maturity. Then we have to know the difference between realized trading gains as well as mark to market, or the unrealized or paper gains of a government securities position. And then lastly, we should have an awareness of some generally accepted market trading practices that professional fixed income dealers adhere to. So the presentation is subdivided into 3 parts. The first part will tackle basic bond mathematics, which should basically be a review of your basic finance courses in college. Next, we will talk about government securities valuation. And then lastly, we will learn government securities trading. So let's start off with basic bond mathematics. Okay, mathematics is best understood or appreciated when it can be used to explain certain theoretical or conceptual relationships. In the world of finance, a widely accepted process that helps investors determine the fair value of an investment involves some sort of DCF method, or discounted cash flow methodology, right? And this is what is known as asset valuation. So 3 important concepts that we must learn to understand and appreciate exactly how mathematics can be used to explain certain relationships in finance, particularly bonds, is bond price, the first concept. The second is bond yield. And then the third is the relationship between bond price and yield. Okay, so at this point, I want you to keep in mind that the thing that we must take note of is asset valuation is essentially just determining the present value of all expected future cash flows. So valuing a bond involves 3 steps. Okay, and at this point, what we should know, or what we should take note of, is bond value is just the present value of future cash flows. So the first step is, obviously, we have to estimate what these future cash flows are. And for bonds, it's not difficult to estimate future cash flows because bonds generally have fixed cash flows. And we know at this point that cash flows of a bond are just 2 things. It's the coupons, or the interest payments, as well as the principal, or the face value of the bond. Now, in equities, when you do valuation, you do a similar thing. What are the cash flows of an equity instrument? It's usually just either the dividends or the free cash flows of a company. So in the bond space, what we use is the coupons as well as the face value, or the principal. The second step is, what discount rate can we use to be able to discount these future cash flows? So in bonds, the discount rate is normally the yield to maturity, which is your required rate of return on your investment. Remember, the discount rate, the yield to maturity, should reflect the underlying risk of the investment. Okay? And then the third, once you've estimated the cash flows and you've already elected an appropriate discount rate, which reflects the risk of the investment, you can now compute for the present value using a discounted cash flow method. All right. Okay, let's talk about each concept one by one. So the first concept is bond price. Now, what is bond price? Bond price is how much you pay today for a bond in exchange for receiving the coupons as well as the face value or the principal. Now, bond price is normally expressed as a percentage of face value. Now, you'll sometimes see a price of a bond at 105, sometimes you'll see it at 100, sometimes you'll see it at 98. Now, what this pertains to is how much percentage of face value will you have to pay today to receive 100 at maturity. So if you're paying today a bond at 105, essentially that means you're paying it at a premium. It's more expensive. You pay 105 today to receive 100 at maturity. If you're buying it at par, which is normally the case when you buy a bond during its issue date, you pay 100 today to receive par at maturity or 100. Now, if it's at 98, for example, that's an example of a discounted bond. And if it's discounted, that means you're buying it at a cheap price because you will only pay 98 today, a discounted amount, to receive 100 at maturity. Now, I want you to take a look at this formula. This is the general bond price formula. And we will keep on seeing this formula as we go through the slides, because this is very important. We're talking about bond valuation here. So you have to keep this at heart. You have to always know what are these different elements that form part of the bond price. And it's just very straightforward. It's just really the cash flows, the coupons, and the face value, as well as the yield to maturity. Now, I put this funnel here on the left to show you that the bond price, a big part of the bond price is really the face value, okay? And a small portion of the bond's price is attributable to the coupons. So it's still the face value that is a big portion of the bond price. So the second concept is bond yield. All right. This is probably one of the more important concepts as an investor that we need to know, because yield captures a lot of things. It reflects a lot of information about the bond, about the investment. And one of the more important information that you can get from the yield is the fact that it can be perceived as how much is the return that you will be getting from this investment. Remember the yield to maturity. Now, it's essentially the effective return that you will get assuming you held on to the bond until maturity, all right? It's also reflective of the risks of the bond. So if it's a higher risk bond, you have to require a higher rate of return and a higher yield to maturity, and vice versa. Now, we can also think of the bond yield as a mathematical concept. The bond yield is a discount rate that you will be using to take the present value of all your future cash flows. And it's that discount rate that forces an equality between how much you should pay for the bond as well as the present value of the future cash flows. And then lastly, it is also a reinvestment assumption. Now, for the yield to actually take place, like for example, you're buying a bond at 5%, a 5% yield. For that 5% to actually take place, that 5% annual return to actually be realized for you as an investor, each and every time you receive the coupons, every 6 months for a semi-annual bond, or every quarter for a quarterly bond, a quarterly coupon paying bond, there's an assumption here that you are reinvesting this cash flow, these coupons, back in the same rate as your yield to maturity for that 5% to be realized. So that's an important assumption as well in terms of bond yield to maturity. So again, take a look at this formula. You have to know this by heart, because since you are in this competition and we are trading government securities, we have to understand exactly how is the bond or the government securities price computed. And you have to know this by heart, really. This is really an important concept that you must learn when you are in the fixed income markets. And then third, let's now try to tie this up. What is the yield and price relationship in the bond space? Looking at this formula, right? Again, looking at this formula, you can see that mathematically, there's an inverse relationship between your bond yield and your bond price. As your yield goes up, the bond price goes down. As your yield goes down, the bond price goes up. So that is the mathematical relationship between bond price and yield. Okay. Now let's use an example. Assuming we buy a 2-year bond with a coupon rate of 10% that is paid out twice a year. Now we have an example here that this bond is purchased at par, at premium, as well as at a discount. So I made 10% as our coupon rate, so it's easy to see this illustration. So at a 10% coupon rate, that means every year, if assuming that your investment is 100, you will receive a 10 coupon every year, 10 pesos, right? So since it's semi-annual coupon paying, it's actually 5 pesos every 6 months and 10 pesos every year. So since it's a 2-year bond, we expect to receive a total of 20 coupons by the end of the investment, by the end of the second year. Now, this bond is being purchased at par rather, because your yield to maturity is at 10%, and it's the same as your coupon rate. So remember, when we talk about yield to maturity, this is effectively what is your rate of return, total return or effective return for holding on to this bond until maturity. Now, obviously, because you're paying the bond today at the price of 100 and you're receiving 100 at maturity, this is a par bond. Okay, so keep that in mind always when you're buying a bond at par, wherein the coupon rate is the same as your yield, you're paying par or 100 to receive par or 100 at maturity. Now, for a premium case, a bond that's purchased at a premium, what is the relationship between yield to maturity and coupon rate? Your yield to maturity is actually lower. It's 9% in this example, 9%. Now, why is your total return only 9%? The answer is because you're buying this bond at a premium. It's a little bit more expensive because you are actually paying an extra 1.79 pesos today as your price, 101.79, to receive only 100 at maturity. Obviously, it's expensive. So if you consider that extra cost for paying this bond or for buying this bond, this reduces your annual effective rate of return to 9%, right? Now, on the flip side, if it's a discount bond wherein it's bought cheaply, like in this case, 98.25, because you have a discount of 1.75, you're only buying it at 98.25 today, and you will receive 100 at maturity. If you consider the 10 coupons that you're receiving every year, plus the fact that you bought it cheaply today at a discount of 1.75, your total return is actually 11%. So again, your yield to maturity is your equalizing factor here. It reflects the total returns from holding onto this bond. Now, let me show you one thing here, right? It's noteworthy that bonds exhibit a very unique characteristic known as bond curvature, okay? Bond curvature or bond convexity. Now, the price and yield relationship is nonlinear. It's curved, in fact. And this illustration or this graph shows you this relationship. Now, what do you notice? We started off with a 10% yield bond, and then we saw what is going to happen when we increase the yield to 11% or decrease the yield to 9%. So either way, it's a plus 1% or minus 1% difference in your yield. Now, what do we see in terms of what is the price, assuming you have a higher yield by 1% or a lower yield by 1%? When the bond is purchased at 11% yield, its price is 98.25. If your bond is purchased at 9%, it's purchased at a premium of 101.79. So the difference between 101.79 and 100 is 1.79. And the difference between 100 and 98.25 is 1.75. And that's the premium and discount here. So what do you notice? It's different by minus 1% and plus 1%, but the difference in price is not linear. It's not the same. And it's because of the curvature of the bond. Okay, and that's an important thing that you should take note of in the bond space. So for the second part, we're going to talk about government securities valuation. Now, in this particular part of this lecture, we will be applying asset valuation principles to both coupon bearing as well as discounted instruments in government securities, which will be traded in the competition. So the three types of GS we will be valuing today are FXTNs, or fixed rate treasury notes, retail treasury bonds, RTBs, as well as treasury bills. Now, fixed rate treasury notes use discounted cash flows for valuation. Okay, it's an NPV formula. Now, a fixed rate treasury note is a coupon bearing instrument with semi-annual coupons, so it's paid out every 6 months. And the coupons are paid to investors net of 20% withholding tax. The tenors on FXTNs range from 2 years up to as long as 25 years. And they are quoted in the markets on a yield to maturity basis, meaning when you buy or sell in an FXTN, you will be quoting a yield to maturity as the price, quote unquote, of the FXTN that you are buying or selling. Now, it's also important to note that the day count convention for FXTNs is 30 over 360. Now, what does that mean? 30 over 360 pertains to an assumption as to how days are treated when you are accruing interest for a bond. So since it's 30 over 360, this assumes that each month has only 30 days and each year has only 360 days. When we know in reality, bonds can days in a calendar year can actually be 364, 365, so on and so forth, depending on whether it's a regular calendar year or a leap year, correct? But for ease of calculation, um, 30 over 360 makes it easier to compute for interest accrual because you're only assuming 30 days a month and 360 days a year. So if you're saying it's February, February assumes that there's still 30 days in the month. January, we know in actuality has 31 days. We assume it only has 30 days in a month. June, we know has 30 days in a month. It is 30 days in a month. Okay, right. So this is your formula for a fixed rate treasury note. Now, before you get all, before this blows your mind, I think it's best for us to break down this equation or this formula and try to look at it more conceptually and more operationally so that we can appreciate exactly how the price is computed. Now, this is nothing but your usual bond valuation formula, right? Remember, in our time value of money discussions in our basic finance subjects in college, we were taught how to compute the present value of a bond as well as the future value of a bond, right? Now, this is basically just your present value formula, but it has been tweaked to become put emphasis or be specific to the Philippine case. All right, there are a number of adjustments in the general bond valuation formula that we've learned in college to be able to account for certain realities in the fixed income markets, and particularly in the Philippine fixed income markets. Now, what are some of the realities? Some of the realities are: one, Philippine fixed income instruments are subjected to 20% withholding tax, right? Two, another reality is some bonds don't have annual payments, but rather semi-annual payments. Like in the case of a fixed rate treasury note, since it pays out coupons every 6 months, we have to adjust the general bond valuation formula to account for the fact that it's paying out coupons twice a year. And another important thing is the fact that, which is more important, I think, especially since you guys are in a trading competition, it's possible for you to buy a bond that is not on the issue date or not on a coupon date. So it's possible to buy these bonds in between coupon dates. And because of that, you have to adjust your formula. That's why you have this very elaborate formula right in front of you on your screens. This formula adjusts for all of these three realities that I just mentioned. So let's look at this. I said a while ago that when you buy a bond, what you pay for is the settlement amount. The settlement amount is the actual cash that you give to the seller of the bond to you. Now, what is the formula for the settlement amount on a bond, which is also known as the dirty price? It's just the present value of all the future coupons and the face value. So it's just this part of the equation. Please don't, this part of accrued interest is not part of the equation for settlement amount. It's just this part. Okay. So this part is the present value of the coupons. This part is the present value of the face value. All right. Now let's look at other things here. What are some of the other adjustments or weird things that we're seeing in this formula? The numerator, this is your coupon. This is how much you will receive every 6 months. So it's the face value times the coupon rate times 0.8 divided by 2. What is this 0.8? This is your tax factor. We know that Philippine government securities are subjected to 20% withholding tax. So we have to express the coupons net of the withholding tax. That's why we're multiplying it by 0.8. 0.8 was arrived at by doing 1 minus 0.2 or 1 minus the tax rate of 20%. So your tax rate is 0.8. Now, face value times coupon rate times 0.8 divided by 2. The reason why we're dividing it by 2 is because we are trying to compute for the semi-annual cash flows, because an FXTN is a semi-annual coupon paying bond, right? So now that you know the numerator, okay, so you know that this is fixed because bonds have fixed cash flows, FXTNs have fixed cash flows. You know that all of the coupons will be paid out same amount every 6 months during the coupon payment date. So this is a fixed amount. So it's easy for you. Remember the 3-step valuation process. The first step is estimate the cash flows. So you have to estimate what are your net cash flows or net coupons from this bond. Now let's talk about the denominator. What is this? This is the part of the formula that you will use to discount these future cash flows to their present value equivalents. And remember, when you do present value at any DCF method, you use the discount rate, or in this case, the yield to maturity to compute for the present value of these future cash flows. So here, the denominator is 1 plus YTM, or yield to maturity. And what do you notice? You multiply the yield to maturity by 0.8. Again, why do you do this? There has to be consistency in terms of the yield as well as the cash flows on an instrument. So if your cash flows that you expect to receive in the future are net of tax, you should also discount your discount rate. You should also adjust your discount rate by the tax factor as well. So it's consistent. Why? Because again, you're talking about the uncertainty of the future cash flows, and the future cash flows are net. So your yield to maturity should also be expressed net. And similarly, not just the tax, but also you also have to convert your yield to maturity, which is a per annum discount rate, into semi-annual basis, because this is a semi-annual coupon paying bond. So this part of the equation converts the yield to maturity to a semi-annual rate. Okay? So I hope you understand that this is the PV of coupons part of the formula. Now, this part is the present value of the face value. The face value is the last cash flow that you will receive when holding to a bond and holding on to a bond. So it's essentially similar to your PV of your coupons, but this is taking the present value of your future value or your face value. It uses the same formula as your PV of coupons, but this is the very final cash flow, capital N, meaning your final cash flow. Now, this is weird. I'm sure you're asking me, why is the exponent n minus 1 plus DSC over 180? Remember, in our present value discussions in basic finance in college, our exponents are normally whole numbers, right? So if it's a 10-year bond that pays annual cash flows, your n is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, right? 10 being your last cash flow or your final cash flow. But how come you have this weird formula for your exponent? Now, the answer is, remember I mentioned a while ago that it's possible for you to buy a bond in between coupon dates, or not during the issue date, or not during a coupon date, right? Because it's possible for you to trade the bond anytime throughout the life of the bond. And because you have that possibility of trading the bond in between coupon dates, that essentially means that a certain number of days have accrued or have lapsed since the last coupon date or since the issue date. So essentially, if you think about it mathematically, if you're discounting future cash flows, shouldn't you be discounting future cash flows that have already been reduced because a number of days have already passed or lapsed since the last coupon date or the last coupon date or the issue date? That's precisely it. You have to adjust your future cash flows to account for that. So that's basically this. Now, what is DSC? DSC is the number of days from the settlement date of the bond until the next coupon date, right? Okay. So that is essentially how you compute for the settlement amount for an FXTN. I will show you an example later so you can appreciate this more. Now, the other important thing that we should be able to know how to compute by the end of this course is compute for the clean price. Now, what is the clean price? The clean price is actually the peso value equivalent of your yield to maturity, right? So this is essentially the settlement amount of your bond minus accrued interest. So what is accrued interest? Accrued interest is the difference between, the accrued interest is how much interest or coupons have accrued on this bond when you purchased it, right? So AD pertains to accrued number of days from the last coupon date. Okay, later on I'll show you a cash flow diagram, so it's easier for us to understand exactly how you compute for settlement amount and clean price. But notice that this is just your PRT formula. This is your PRT formula, wherein your T is the number of days that has lapsed or accrued since the last coupon date or the issue date. So let's use an example. I'm using the FXTN 3-25, which is a semi-annual coupon paying government security with 1.5 years to go until maturity. Now, the coupon rate on the FXTN 3-25 is 2.375%. The maturity date is September 10, 2023. Let's assume that we bought this on March 28 for settlement T+1. So it will settle on March 29. And let's assume that the face value of this instrument is 100 million. And we are buying it at a yield to maturity of 3.175%. So what are we going to try to do here? We're going to try to compute for two things: the settlement amount as well as the clean price. So this is a cash flow diagram that shows you expected cash flows from this FXTN 3-25. Now, for the first step, we want to create a cash flow diagram. I made this so that's easier for us to illustrate the cash flows. Okay, so a cash flow diagram shows you all future cash flows and the current cash flow. Okay, so in this case, since we know that this bond has a maturity date of September 10, 2023, okay, we can put this at the very end of the cash flow diagram. Now we know that we bought the bond today, March 29, 2022. So we will move 6 months backwards to see what are the coupon payment dates, because we know that the maturity date of September 10, 2023 is the last or terminal cash flow date. We know that the other coupon payment dates, apart from September 10, is 6 months back. Okay, so September 10 minus 6 months is March 10, 2023. So we know that's a coupon date. And then if we move back another 6 months, that's September 10, 2022, which is another coupon date. And then if we move back another 6 months, it's March 10, 2022. However, we bought the bond on March 29. So our settlement date is March 29. So since March 10, 2022, the previous coupon date is a previous cash flow, it is no longer relevant to the analysis. So we know for a fact today, what we're going to try to do today is how much is the settlement amount that we have to pay for this bond today, and how much is the clean price. Okay. So the first step, estimate the cash flows. We know that the bond is a 100 million face value bond with a coupon rate of 2375. So if you use your formula, face value times coupon rate times 0.8 divided by 2, the semi-annual coupons is 950,000. So these are the estimated cash flows given the formula of how to compute for the coupon. So we will receive 950,000 on September 10, 950,000 on March 10, and 950,000 on the terminal cash flow date or the maturity date. So that's and we also know that upon maturity of the FXTN or any bond, we will also receive face value. So the terminal cash flow is the 100 million face value as well as the 950,000 final coupon. Now that we've estimated the cash flows, that's the first step, right, in the bond valuation process, estimate the cash flow. Next, what is the discount rate? The discount rate is your yield to maturity. So our yield to maturity is 3.175%. So these cash flows, the 950,000, 950,000, and 100 million, 950,000, we will take the present value each of these cash flows at 3.175% yield to maturity. Right? That's the second step. Okay, and the third step is actually computing it. Okay, actually computing the present value. Now, it's important to note that although our ends here are whole numbers, just like in what we've been learning in our basic finance classes in time value of money, the reality is we can use n equals 1, n equals 2, and n equals 3 as our exponents to our denominator in the formula. But that is assuming we bought this bond on this part of the timeline during the coupon payment date, the last coupon date, which was March 10, 2022. But the fact is we bought this on March 29. So since we bought this on March 29, we have to adjust this part of the formula, the exponent in your denominator, to account for the fact that 19 days had passed since the last coupon date. And there are 161 days until the next coupon date. All right. So if you consider this, and this is that part of the formula I was talking about a while ago, the n minus 1 plus DSC over 180, your exponent for your first cash flow, which is this one, becomes fractional. It's 0.8944 because it's 1 minus 1 plus 1 minus 1 plus 161 over 180, 161, because there are 161 days until the next coupon date. Hence, it's 0.8944. And when you take the present value of this first cash flow, using the yield to maturity of 3.175, your 950,000 cash flow, the present value is 939,336.77. And you repeat the same process for the remaining two other cash flows, which is this cash flow, which is 1.8944 which has an exponent of 1.8944, right? So the present value of that cash flow is 927,000. And the final cash flow, which is a combination of the last coupon as well as the face value, you have a present value of 915,000 and 96.4 million. Okay. So if you take the summation of all these present values of these future cash flows, you have 99,195,929.89. Now, this is the dirty price or the settlement amount for this FXTN that you purchased on March 29. And the settlement amount, this is the actual cash outlay for buying this FXTN 3-25. Now, remember that formula has that extra part, that accrued interest. If you deduct the accrued interest, that will give you the clean price of the bond. The clean price, again, meaning the peso value equivalent of the yield to maturity. Okay. So if you deduct the the accrued interest, which is actually 100,277.78, and how did you get that? This is computed as PRT. Okay, PRT, it's 100 million face amount times the coupon rate of 2375 times 0.8 times accrued days. The accrued days is 19 days times 19 days over 360. So you deduct the amount of interest that has accrued over 19 days from your settlement amount to give you your clean price, right? Now, why is it clean? Because the concept of accrual of interest makes the valuation dirty. Yun lang yun. That's the reason why it's called clean price. Your settlement amount is your dirty price. It's dirty because it includes accrued interest. If you deduct the accrued interest, it gives you your clean price. All right. Okay, I hope that's clear. I try to make this as operational as possible, so you understand exactly how the bonds are being priced or being valued in the fixed income markets. Now, important things to take note of here. Don't forget, cash flows should be stated net of the withholding tax. Your yield to maturity should be stated net of withholding tax. When you take the present value of your future cash flows, you have to adjust for the fact that a number of days have accrued from the last coupon date, which makes your future cash flows, your ends, fractional in nature. Right? Okay. So let's move on to retail treasury bonds. Now, retail treasury bonds are valued the same way as an FXTN. However, the main difference between an RTB and an FXTN is the fact that the coupon payments on an RTB are quarterly, so every 3 months. Taxation is similar, 20% on the coupon. Now, the typical tenors of the RTBs that have been issued by the Bureau of the Treasury are 3 years, 5 years, 5.5 years, 7, 10, 15, 20, and 25 years. RTBs, just like FXTNs, are quoted in the markets similarly as FXTNs, on a yield to maturity basis. And then it also uses the same day count convention where you assume 30 days in a month and 360 days in a year. So you'll notice the formula is very similar, but the only difference here is you have divided by 4 on this part of the equation because your cash flows, your coupons are paid out 4 times a year, hence divided by 4. What else is different from this formula? Your exponent, when you adjust the remaining term to maturity of your cash flows, you use 90 as your denominator here because there are only 90 days for each cash flow payment period. Okay? But everything else is the same. You use the same process, you use the same, operationally, you do the valuation the same way as an FXTN. You just have to account for the differences, these nuances, in terms of the number of cash flow payments every year, which is 4 times a year, and 90 days for each cash flow period. So we'll use this example, an RTB 3-10, which is an RTB that has 0.9 years left till maturity. The coupon rate here is 4.375. The maturity date is February 11, 2023. Let's assume also that we bought this bond on March 28 for settlement T+1, March 29. And let's assume a face value of 50 million and the yield to maturity of 2.585%. So here you notice that the yield to maturity is at 2.585% versus the coupon rate of 4.375. This is a premium bond. Remember a while ago in the FXTN example, it was a discounted bond because the yield was higher than the coupon rate. For this particular example, it's the opposite. It's at a premium. So if we try to take a look at the cash flows, again, we use a cash flow diagram. And here we have 4 remaining cash flows left until maturity. It's just less than a year, but because an RTB pays out coupons 4 times a year, we expect 4 more coupon payment dates until maturity. So the maturity date is Feb 11, 2023. Okay. So we know this is the terminal cash flow date. Now, you will move backwards by 3 months. 3 months because each coupon payment date is every 3 months. So Feb 11 minus 3 months is November 11. That's a cash flow date. November 11 minus 3 months, August 11. And then another minus 3 months is May 11. Now, if you deduct another 3 months, you're going back again to February 11. But again, you bought this bond on March 29. So your cash flow diagram should essentially start on March 29, and you do the present value as of this date. Okay, right. Next, let's estimate the cash flows. We estimate the cash flows, the coupon payments every 3 months. So the coupon payment formula is face value times coupon rate times 0.8 divided by 4. So if you do that, our coupon rate again is, let me get 4375. So your quarterly cash flows are 437,500 pesos net of withholding tax, assuming a 50 million face amount. So you will put these cash flows every 3 months. And then on the final cash flow, 437,500 plus your 50 million, that is your terminal cash flow. Okay. Now that you've estimated all of your future cash flows, what is your discount rate? You will use your discount rate of 2.585%, which is your yield to maturity. And you will use that to take the present value of these 4 cash flows. And then lastly, the third step in the process is to actually do the computation, actually do the present value formula, actually implementing it. Now, take note here that you have to adjust again. You cannot use whole numbers as your exponent in your formula when you do the present value, because 48 days had passed since the last coupon date, and there are 42 days remaining till the next coupon date. So you have to adjust your exponent in your denominator to account for that. So the first cash flow has a 0.4667 exponent. Okay, so it's 1 minus 1 plus DSC over 90. So that's 1 minus 1 plus 42 over 90. Hence, you get 0.4667. And if you take the present value of this 437,500 cash flow, your PV is 436,448.44. And then you do the same process for the remaining 3 cash flows. This time, with a cash flow tenor of 1.4667, 2.4667, and the last cash flow of 3.4667. If you take the summation of all these future cash flows, your settlement amount or dirty price is 50,846,487.95. This is how much you will actually pay to the seller of this RTB 3-10 to you. Now, if you want to know what the clean price is, you just deduct the accrued interest. Accrued interest is your face value times coupon rate times 0.8 times accrued days, 48, divided by 360, which is 233,333.33, which gives you a clean price of 50.6 million. Now, this is a premium bond. You're paying this much to receive 50 million at maturity. So the third government security that we will do a valuation for today is a treasury bill. Now, the valuation method for a treasury bill is discount to yield. It's not the regular discounted cash flow formula for coupon pairing instruments. It uses a discount to yield formula. Now, obviously, because treasury bills are zero coupon securities, there's no coupon payment frequency. Okay. Now, taxation is also 20%. However, because of the structure of a treasury bill, which is a discounted instrument, as opposed to coupon-bearing instruments such as FXTNs and RTBs, the taxation on the treasury bill is upfront. Okay, so meaning you are already taxed at the very start when you buy the treasury bill, as opposed to your FXTNs as well as your RTBs, wherein the tax is withheld and it's given to you net. Yung coupons are given to you net of the withholding tax after the coupon has accrued in your benefit or on your behalf. Okay, so that's important. You will only receive your cash flows net of tax at the end of the coupon payment period, and these are already withheld at the end of the coupon period. As opposed to a treasury bill, you have to pay the tax today when you buy the bond. Okay, so it becomes more expensive because you have to pay the 20% tax. Now, the typical tenors of a treasury bill are 91 days, 182 days, and 364 days. Now, the quoting convention is also on a yield to maturity basis. So when you buy or sell this in the fixed income markets, what is quoted to you is a yield. And your day count convention is different because it's a discounted security and it's less than a year in tenor or maximum of 1 year. The day count convention is actual over 360. So it's possible for you, even though in reality you don't count the number of days, you count the actual number of days. So for example, for a January, there's an actual 31 days in January, February 28, March 31, April 30, so on and so forth. So you count actual number of days per month when you're doing the accrual or the accretion of the discount on a treasury bill. Okay. So this is the formula for a treasury bill. There's actually 4 steps to compute for the settlement amount. So you compute for the discounted proceeds, which is basically again, this is very familiar. It looks like a regular present value formula in finance. You have the face value discounted to present value, okay, using the yield to maturity. But note here that T is your actual number of days until maturity of the T-bill. All right, actual number of days, because you assume an actual over 360 day count convention. Now, the next step is once you've computed the discounted proceeds, you compute the actual discount. The actual discount is the difference between your face value, which is what you will receive at maturity, and the discounted proceeds, which you computed here. Once you have the discount, you apply the 20% withholding tax to the discount. Guys, I'm sorry about this. This should actually be 0.2. This should be 0.2. Discount multiplied by 0.2. So please take note, this should be 0.2. So the withholding tax is the discount amount multiplied by 0.2. So once you have this amount, the withholding tax, you add this withholding tax to the discounted proceeds to get the settlement amount. Okay? So I'll change this to 0.2, but please take note of that. It should be 0.2. So for us, an example T-bill, we have a T-bill that is maturing on June 22. We bought it on March 28 for value T+1 or settlement T+1. So March 29 is the settlement date. We have a face amount of 200 million and the yield to maturity of 1.4%. So how much are you going to pay for this treasury bill? So if we implement the formula, the discounted proceeds given a 200 million face value and a 1.4% yield to maturity, and given that we are buying this bond on March 29 settlement date, there is 85 days, actual days from March 29 rather, until the maturity date of June 22, 2023. I will have to amend this again. This should be June 20. Yeah, this is correct. June 22, 2022. That's right. So there are 885 days. So the discounted proceeds is 199,341,067.03. The discount is the difference between these two, the 199 million and the 200 million. So essentially, the discount is 658,000. So imagine what the value in a treasury bill is. You're buying it at a discount. And the bigger your yield to maturity is, the bigger your discount is, right? Imagine if this were 2%, this amount would be bigger because the difference between these two would be bigger as well, right? And then you have to compute for the withholding tax. The withholding tax is 658,000 times 0.2. Guys, this should be 0.2. Sorry about that. This should be 0.2, which is 131,000. And you add this 131,000 to your discounted proceeds of 199,341,067.03, which gives you a settlement amount of 199,472,853.62. So this is how much you will pay today for this treasury bill, which will mature on June 22. And given that you paid this 199 million, you will receive 200 million at maturity. So let's move to the third part of this lecture, which is government securities trading. Now, this is the more exciting part because I know all of you are excited to start trading with one another. During the first round, you are just trading with the market. So you're
Sorry,
taking
Clive.
yes.
Clive. But maybe the students have questions before
Oh,
we
yeah,
go
yeah.
into that.
Yeah, sure. Yes, I'll stop here. Thank you, Chris, for stopping me there. Are there any questions on the valuation part of GS? I'm opening the floor to questions. You can let me know what particular part of the presentation you want me to give more emphasis on, so that before we proceed to the this part of the lecture, the part 3, I can already address any questions you may have. Don't be shy, guys. This is your chance.
Yeah, you may unmute yourselves.
Yep, you may unmute yourselves, please.
Shy ba sila o wala napakalinaw ng your explanation was very
It's
crystal
either
clear.
it's a super duper clear, crystal clear, or they're shy. Yeah, that's right. Hindi kami nangangagat.
Mm. Mukhang
Is it clear? I hope it's clear. The reason why we did some adjustments to the formula, at least on the bonds part. Is it clear why we have these formula adjustments? The point eight, the point both the numerator and the denominator, meaning your cash flows have to be net of tax. The discount rate should also be net of tax. And you're dividing the numerator and the denominator by the number of times you're receiving the cash flow within the year. So 4 times for a quarterly bond and 2 times for a semi-annual bond. And then you also have to adjust your exponent because it's possible for you to buy the bond in between coupon payment dates. So you cannot use an exponent that is a whole number. It has to be fractional because of the lapse of time since the last coupon date or the issue date. Okay. And then the settlement amount, your settlement amount is just the present value of your coupons, the summation of this, and the present value of your face value. That's how much you pay to the seller of the bond. And then for the clean price, when you compute that, you just compute the settlement amount and deduct accrued interest. Accrued interest is how much interest or coupons has accrued to you from the last date until the time that you actually buy the bond. So
Okay, there's a comment here. It's clear. So you can proceed. I think you can proceed.
okay, thank you very much, Outsmart Trading. Okay, let's move on. So government securities trading. So at this point, I'm sure a lot of you are already excited to progress to round two. Because in round two, that's where you will have the opportunity to start trading with one another, start trading with the other teams. Because currently in round one, you are trading with the market. So you are buying and selling securities at the market rate for the previous day, right? The BVAL for the previous day, correct? So essentially, all of you are on the same page. You're buying and selling bonds at the same yields, and it's available to you fairly, equally, because all of you can potentially buy these bonds on these 6 securities at the same yields. Magkakatalo na lang kayo dun sa amount that you are buying as well as what specific bonds you are buying, di ba? Kasi so fair game siya, right? Now what's gonna happen is when you go to round two, you will now be able to trade with one another, and you will have a 1 hour window every single day from 4 to 5 to be able to negotiate trades with one another. You can negotiate the security that you want to trade. You can negotiate the yield. So you can choose at what yield you want to buy or sell. But we are setting a rule wherein you can only quote a yield to your counterparty when you're trying to negotiate the trade within 25 basis points of the BVAL. Chris, that's right, diba? We're setting a 25 basis point limit on the
Yes,
on the
yes,
on the quote.
yes.
Okay. So
That's
plus
right.
okay, so that you have a 25, it cannot be beyond 25 basis points from the BVAL. Okay. So I want this part of the lecture is supposed to tackle some of the more commonly accepted or widely accepted trading practices as well as conventions in terms of how market participants trade with one another. There should be a widely or commonly or generally accepted practice in the way we trade so that it is unambiguous. There should be rules as well as behaviors that are expected by everybody, so that everybody's because we don't want, because we're dealing with money here in investments, there should be a common language by which market participants and professionals talk with one another and deal with one another, so that we minimize the cases wherein there are merong mga anong tawag doon, yung merong may magreklamo na hindi tama, or there's a term for that. May mag-dispute, rather. That's the terminology I'm looking for. We want to minimize the instances of dispute in trades. So by having a commonly accepted convention or commonly accepted set of rules, this minimizes those costly disputes and errors. So let me talk about who are the typical participants in the secondary market trading of government securities. Now, there's a special participant in the markets known as a GSED, a government securities eligible dealer. These are normally banks and non-bank financial institutions that actively deal in government securities. All right, they participate in the weekly auctions. That's one of the benefits of being a GSED, and they're normally known as market makers. A market maker is a participant who shows both a bid and an offer for government securities. So they make a market. And when you say you make a market, you're always showing a willingness to buy and to sell a security. And by having that role of a GSED, you're creating more liquidity in the secondary markets. And you need market makers. They're essential and crucial participants in the markets because they create liquidity. And by liquidity, what we mean is if you are a client, an investor, and you want to buy government securities, you can go to a GSED because you know for a fact that GSEDs will always or almost always show a price or volume of a security that you want to buy because they're making markets. And they're not just on the selling side, they're also on the buying side. So on the flip side, if you're a client, you're a retail investor or an institutional investor, and you want to sell your existing holdings of RTBs, FXTNs, or treasury bills, you can approach a GSED who will buy it from you. So that's what making a market is. And that's the essence of trading. Trading is earning out of actively buying and selling securities. And by making a market, by showing both a bid and an offer, you are creating liquidity in the markets because liquidity talks about how easy it is that you can actually flip or churn the securities that you have, or you can easily convert it to cash. You can easily transfer ownership from one investor to another. Market makers such as GSEDs allow for that, right? So GSEDs can deal with other GSEDs. Normally, the GSEDs, as I mentioned, are are banks and non-bank financial institutions. And again, it's not only the GSEDs that make this market. It's also possible for non-GSEDs, such as other banks and financial institutions, to be part of this market. All right. So if you are a non-GSED, you are also an investor or a trader in government securities. However, you're not required to make a market. Okay. You can either be most of the time you're a buyer. Okay, you're an end user. So you buy the government security and end up holding it in your books and holding it till maturity because you want to enjoy the accrual. But again, this doesn't preclude you if you're not a non-GSED. This doesn't preclude you or prevent you from selling the bond prior to maturity. You can do that as well. Now, if that's the case, you can choose to sell this to another bank or another financial institution, or you can sell it to a GSED. And more often than not, the GSED will provide better liquidity as well as better levels or better prices because that is their role. They're supposed to provide good pricing on various government securities. Now, who are the typical parties to a GS transaction? You have a quoting party and the calling party. All right. Now, what is this? Now, a quoting party is that party, let's say, for example, a government securities eligible dealer, a GSED, who is making a market. So a GSED can show both a bid and an offer, which is also known as a two-way price. Okay, so if you have a GSED showing a two-way price, I bid at this level and I offer at this level for a particular bond or for a particular treasury bill or a government security, he is or she is a quoting party. He or she's the one quoting a two-way price. Now, the calling party is that party who is asking for the price. So, for example, I am a client and I would like to buy a government security and I go to a GSED. I am the calling party and I will approach the quoting party, the GSED. I would like to buy a government security. What is your offer? Or what is your offer for this government security? The quoting party will show the offer and the calling party is the one who asked for that offer. On the flip side, I can also be a client who wants to sell a government security. So if I want to sell a government security, I am looking for a bid. So I'll approach a GSED, who is the quoting party or the market maker, who can show a bid on this. He will say that I am buying this government security at this level. So again, I as the client I am the calling party because I am the one asking for the price. So you have to make sure that you understand these differences, because a calling party and the quoting party, that will determine at what price or level you should be dealing the government security. And we will discuss this in a succeeding slide. So here's an example of a quote that a GSED or a quoting party or a typical market maker would provide to a client or to a counterparty. So for 50 million RTB 5-15, I quote 512551. What this actually means is the market maker is telling the counterparty or the client or the broker that I am showing a two-way price. I am showing a willingness to buy and to sell by showing both a bid and an offer. And I'm pertaining specifically to the RTB 5-15 for 50 million volume at a rate of 5.125% yield to maturity as my bid and 5.1% yield to maturity as my offer. Now, as a quoting party, there's an interpretation of what this 5125 bid and 551 offer actually means. So what it actually means is, as the quoting party, I am showing a bid of 5125%. I am expressing my willingness to buy the RTB 5-15, 50 million at a rate of 5125%. So I am quoting a bid that is my willingness to buy. That is the quoting party's perspective. That is the GSED's perspective. That is the market maker's perspective. On the other hand, since I quoted a 5.1% offer, that is me expressing my willingness to sell at a rate of 5.1% on the RTB 5-15 for 50 million volume. Okay. Now, because I showed a two-way price, meaning I showed both a bid as well as an offer, there you can compute what is the potential gain, assuming I can deal at these two levels for that particular volume. So assuming that I'm able to buy at 5.125%, 50 million for the RTB 5-15, and I'm also able to sell the RTB 5-15 at 5.1%, 50 million volume simultaneously, for example. The spread that I will earn by market making the RTB 5-15 is actually 2.5 basis points, which is the difference between your bid rate of 5.125 and your offer rate of 5.1. So now that is the spread. Now that is how traders and dealers make money from dealing GS. You will always you're in the business of actively trading government securities, so you'll always show a bid and an offer, and in the hopes that you can always flip the securities. So the more agile you are, meaning the more successful you are to buy and sell more frequently your government securities and earn trading gains, that means that you're a better trader. You should that means you're able to make that correct call because you're making money. Now, the bid offer spread is 2.5 basis points or 0.025%. Now that I mentioned the concept of a basis point, this is very important to take note of in the fixed income space. What is a basis point? So a basis point is actually 0.01%. All right. So remember, a basis point pertains to 0.01%. All right. 10 basis points is 0.1%. And the 100 basis points is 1 percentage point. All right. All right. So that's important. So again, because we quoted in this example a while ago, bid offer of 5125 bid, offer of 5.1, the difference is 0.025, which is actually 2.5 basis points. Now, let's talk about the calling party, the client. Okay, if you're a calling party and then you approach the GSED or a market maker to show you a two-way price for the 5-15, you'll notice that the interpretation of a calling party is different. So since the quoting party showed a bid of 5125, this is actually the rate in which you, as the calling party or the client, will be selling the bond to the market maker. Okay, so you are selling at 5.125%. Again, on the flip side, since the offer rate that was quoted to you as you as the calling party, the market maker quoted to you a rate of 5.1% on the offer, that is the rate in which you will buy the government security, the RTB 5-15. Notice that it's the opposite. That's why it's important to take note, what is your role, or what party are you in the GS transaction? Are you the calling party or the quoting party? So more often than not, if you're asking for the price, okay, you are the calling party. And if you are quoting the price, you're the one giving the yield levels, you are the quoting party. Right? So in this case, you guys right now at this point of the competition, you are the calling party, all right? And the BVAL rates that are being offered to you on a daily basis, these are the quotes. These are the quotes of the quoting party. It just so happens because you're dealing at the same BVAL rate for the buy and on the sell side, there is no spread. The bid and offer is the same, right? Of the quoting party. But remember, you as a participant in this, in round one, you are all calling parties here, right? And you have to deal at the rates, at the BVAL rates or the rates of the quoting party. Now, let's differentiate an indicative quote from a firm quote. Okay, in the markets, when you trade with one another, normally it's expected that you are showing a firm quote. So if you're a quoting party or a market maker and you show a two-way price, it's expected that what you are quoting is always a firm quote. A firm quote is a quote that is definite and final and cannot be changed, right? And this can actually be dealt. It can be readily dealt by the calling party if the calling party calls that price. So for example, in this case, let's use this example. For 50 million RTB 5-15, I quote 5125 bid and 5.1% offer. What I can do is if I want to buy this 5-15 as the calling party, I can say mine, 50 million RTB 5-15, 5.1%. So I'm buying the 5-15 at 5.1%. Remember, because I'm the calling party, I buy at the quoting market at the quoting party's offer of 5.1%. Okay? Again, the moment nagsalita na yung quoting party or market maker, that's expected to be a firm quote. All right? Now, on the flip side, if this was quoted again for 50 million RTB 5-15, I quote 5125 bid 5.1 offer. And then I am a seller, I'm a client, I'm the calling party and I'm seller and I want to sell, I'll say, okay, yours. So yours means I'm telling the quoting party that I am hitting his bid or her bid at 5125%. So that is the terminology that you will be using once you go to round two when you're dealing with one another. Once the quoting party quotes, and then you, as the calling party who asked for a quote, I can say mine, meaning I'm going to buy the 5-15 at 5.1%, or I can say yours, meaning I'm going to sell at 5125%. And it's clear here that the volume that we're talking about is 50 million, and we're specific to the security at RTB 5-15. Do take note as well that when you deal, the standard settlement is T+1 always. I noticed many of us actually in the organizing team noticed that many of you are specifying T+0 as your settlement date for your transactions. Note that this is not the standard settlement in the GS market. It's actually T+1. It only becomes T+0 if you specify that it be T+0 for whatever reason. But if you don't specify anything, you just deal with your counterparty, it's already accepted and understood that you're dealing at T+1 by default.
And Clive, there is
Yes.
um, just to inform that the T plus zero has a cutoff.
Yeah, that's right. That's correct. For T+0 trades, these have to be dealt before lunch. Ideally, it has to be done before lunch because again, when you're talking about T+0, in reality, in the markets, this is for your appreciation, okay? Because you will be trading in the afternoon. Many of you are sending your trades in the afternoon. In reality, in the markets, when you trade a T+0 transaction, it has to be done in the morning. Why? Because you need ample time for your bank or for your back office or your operations people to actually settle the transaction on the same day. So it has to be done. Ideally, it has to be done before lunch. I think it's 2:30. Is 2:30 the latest, Bakris?
No, it's 12
Before
because
lunch, 12.
um, the settlement of bonds has a specific window. It's between 1 to 2. So if you miss that, then there will be no settlement.
Okay. So important na you have to make the cutoff, the 12 o'clock. So all T+0 trades have to be in or dealt, executed before 12 o'clock. Now again, because in this competition, we don't have those cutoffs. We just want to make sure that you are aware that the reality is, in practice, T+0 trades are done before 12 o'clock. Oh, there's a question. Hi. Okay. Tama ba? Oh, is there a question? Yes, outsmart trading.
Yeah. Can't
Okay.
unmute. Can't unmute.
Okay.
Si ano yun eh. Wait lang. You're
Okay.
you're a host, Clive. You can
Yeah.
unmute him.
I can unmute. Okay. How do I unmute? So syempre, I don't know how to unmute. I have to look for the person in ano no.
Wait lang. Ano name niya?
Si
Ano name
Outsmart
niya?
Gabby
Trading,
Duran.
Si
Gabriel
Gabby.
Duran. Oh, Gabby Duran.
Wait lang
Okay. Hello. Hello.
Hello.
Yan,
Hi,
okay
I
na
Hi.
can
Hi.
hear you.
Hello. So
Hi.
I just have a quick question about the second part of this competition when we're actively trading with each other. So
Yep.
all our trades then at that time will automatically be T+1. There won't be any more T+0.
To answer your question, you can if you don't mention anything, you just deal with your counterparty, just deal with the other team, but don't specify a T+0 or T+0 or T+1. It's understood that it's T+1. It only becomes T+0 if you specifically say so, and and your counterparty agrees that you will settle to T+0.
Okay, got it. Thank you.
All right, no problem. Are there any other questions? Now again, I remember I mentioned the firm quote, right? So if it's understood that when you trade with one another, when you negotiate a trade, that all of the quotes are firm. But if you say that the quote is indicative, that doesn't make it firm. Okay, so you have to mention that the quote is just a reference quote or an indicative quote, meaning it's not dealable. So you're just letting the counterparty know that this is a price that you're gonna give just so that you can show a price, but it's not ready for dealing. Okay, but you have to mention that it's an indicative quote. But let me remind you, na always when you deal, it's always understood that it's firm unless otherwise said na it's not firm. Okay, so you have to say that it's an indicative quote. So for example, you're a calling party and you ask the GSED or the market maker, what is your market lease for the RTB 5-15, 50 million? And then the quoting party says, here is my indicative market. 50 million RTB 5-15, 5125 bid, 5.1 offer. So that is the market maker essentially telling you, I am showing you a price, but you cannot deal with this with me in these levels yet, because this quote is indicative. So, but again, take note that if you don't say that it's indicative, it's understood that the quote is a firm quote. So again, an indicative quote is not a final price. So the quoting party or the market maker can still change this price during the course of a trade as you're negotiating. Kasi sinabi nga niya na it is an indicative quote. Now it only becomes a firm quote if the quoting party actually firms it up and tells you, okay, this is a firm quote now. Okay. After quoting an indicative quote, 5125 bid, 5.1 offer. After a minute, he comes back and says, okay, that 5125 bid and 5.1 offer is now firm. So that's where you can deal. And once he or she says, the quoting party says that it's a firm quote, you as the calling party can say, okay, mine. That means you're lifting the offer at 5.1, or I can say yours. That means I'm selling to the market maker at 5125%. So in the markets, where do you normally see quotations for various GS? Now, the GSEDs will normally show quotes to customers, counterparties, other banks in the interbank market because they actively deal in government securities. You can also find quotes for government securities, various tenors, through the brokers. The brokers also are an important participant in the financial markets, and CAMS, one of the members of the organizing committee of this bonds trading competition. She's from GFI. The GFI is an example of a voice broker. So the GSEDs also deal through the voice brokers. And what we do as a dealer, as a G said, we will provide different markets or quotes, bid and offer quotes across different securities to the voice brokers. The voice brokers create more liquidity as well in the GS markets. Okay, and then you can also find quotes for government securities in Bloomberg and other financial information service providers. But again, many of these quotes that you can find on the Bloomberg and other financial information service providers, consider them indicative, and you would still have to call the bank or the GSED to firm up their offers. Now, how do you take profit from GS trading? Remember, the rule of thumb here is always buy high, sell low. I want you guys to be careful. This rule of thumb only applies to markets wherein the price being quoted is a yield. And that is one thing that is peculiar about the Philippine government securities market. It's only in the Philippines, in a handful of other fixed income markets around the world where you see that the quotation method uses yield to maturity. In other fixed income markets, kasi it uses price. Diba? Even in the equities market, right? The quotation basis is price. So in a price quote market or price quotation market, the rule of thumb is buy low, sell high. But in the Philippine GS market in particular, the rule of thumb is buy high, sell low. Now, I'm sure you're scratching your heads. Why buy high, sell low? It's simply because we're talking about yield. And remember, yield has an inverse relationship with price. So a higher yield means a lower price. So when you're buying high in terms of yield, you're actually buying low in terms of price of the bond. And if you're selling low in terms of yield, you're actually selling high in terms of price. Okay? So buy high, sell low in terms of yield. That's important. Huwag kayong malito ha. Huwag kayong mag-buy high, sell low sa equities. Matatalo kayo. Okay. So because I prepared these slides just very recently, I decided to use some of the teams as an example here. This has disclaimer lang. This doesn't mean that these are actual trades by these teams. I just used the names. So for this example, we have Profit Traders who is dealing with Hydra and Outsmart Trading. Profit Traders is going to buy a security from Hydra, particularly the 5-77 for 100 million at 4.8%. And then simultaneously, Profit Traders decides to sell that same 100 million FXTN 5-77 to Outsmart Trading at a rate of 4.75. So if you use the buy high, sell low rule of thumb, this will become a profitable trade. Okay, and it's profitable because Profit Traders will pocket a trading gain equivalent to 5 basis points, which is the difference between your buy rate of 4.8 from Hydra and sell rate of 4.75% to Outsmart Trading. So exactly how much is the trading gains that Profit Traders will book or generate from this churning trade or this flipping trade? So that 5 basis point difference in the buy and sell rate or your yield is actually equivalent to 145,000 in terms of trading gain. Now, how exactly was this 145,000 computed? Remember, in bond valuation, the FXTN bond valuation, there is this, we computed two things, right? The settlement amount and the clean price. The settlement amount is the actual cash outlay for buying or selling a government security. But that is not the basis for computing trading gains. The basis is actually your clean price. So you will use the bond valuation formula to compute for the clean price from buying from Hydra and the clean price from selling to Outsmart Traders. So that difference in the clean price is 145,000 because the clean price at the buy using the formula for the FXT and the valuation formula is 95.785 million. And then the sell clean price is 95.93. Hence it's 145,000. Now the assumption here is that the buy and the sell trade was done simultaneously. It's settled on the same day, March 29, 2022. Okay. Now, this is how we compute for trading gains. So if you're wondering exactly how the blotter that was provided to you computes for trading gains when you flip a position, this is how it's done, right? If you're wondering how the settlement amount is computed, just think about the formula that we presented earlier, the settlement amount formula, which is the present value of your coupons plus the present value of your face value. So that is the settlement amount or the dirty price. So trading gains, you use the clean price to compute for your trading gains. Now, remember, it's possible for you to hold on to a position and decide not to sell it. You just hold it on for like a few days, 1 day, a few weeks, hold it on until the end of the competition. Now, what happens is on a daily basis, once you hold on or once you establish a buy position on a government security, on a daily basis, if assuming you do not sell this security and you hold on to it in your books, your security is marked to market, MTM. Mark to market is actually a process by which you will value your existing bond holdings using prevailing secondary market yields. Marking to market is a process by which you try to determine how much is your unrealized gains or losses, or in other words, your paper gains or losses from holding on to a GS position. So the concept of mark to market is it's sort of like hypothetically what is going to be the gains or the losses if you decide to unwind or sell or close out your position during that specific day, right? So for example, I buy a bond today and I will hold on to it. Tomorrow, if you decide not to sell it, how much would be the value or that market value of that bond, assuming you hypothetically sold it the next day? And you will use prevailing market rates. And it's usually the BVAL rates that are used as the discount rate when you're doing the bond valuation for mark-to-market purposes, right? So the BVAL rate, again, is going to be used as your discount rate. And then your the clean price will be used to compute for the mark-to-market or the unrealized gains or losses. So let's use that same example. Assuming profit traders, instead of the profit traders bought 100 million 5-77 from Hydra, and in our previous example, they sold it simultaneously to Outsmart traders. Assuming profit traders did not sell it to Outsmart traders and decided to just hold on to it, okay? So he held on to it for a day. So what is going to happen now is the next day, March 30, at the end of the day, profit traders 100 million 5-77 position will be marked against the market. Mark to market again is trying to determine how much is the current market value of that bond, assuming profit traders, you decided to sell it that day. You're just computing for paper gains or losses. So the BVAL rate that day was 4.9%. You bought it previously from Hydra at 4.8%, but the BVAL for the day, the next day, was at 4.9%. So given that the yield increased by 10 basis points, that is a loss, a paper loss, or a hypothetical or unrealized loss to you. So in fact, the losses are actually 285,000 pesos. Okay, so that's the concept of mark to market. And what again is your what is your basis for computing the mark to market? Similar as the basis for trading gains, you take a look at the clean price at purchase and clean price at sale. But since in this case, when you're doing mark to market, this is just a hypothetical sale. So it's what is the clean price, assuming you use the prevailing market BVAL rate to as your discount rate to take the present value of the future cash flows of this 5-77. So and that gives you a clean price of 95.5, which is lower than the clean price at which you bought this bond, which is 95.785. So you will book an unrealized loss of 285,000. Now, why do banks and why do investors practice marking to market? It's sort of a risk management tool because if you do this revaluation, that's what you call it in accounting, revaluation process where you benchmark your bond holdings against current market value, and that's what asset valuation is all about. You're trying to determine, assuming you unwound the position today at current market prices, how much gains or loss you will generate. If you do that on a daily basis, you can see whether you're gaining more and more income or potentially increasing the values of your bond holdings, or it's potentially decreasing the value of your bond holdings, or you would potentially book losses. Now, these are all unrealized losses, itong mark to market. So if you see that your gains are increasing, you might think, okay, maybe now is a good time to sell and realize those gains. And when you actually sell it, that's what you call realizing the gain. It becomes an actual realized trading gain. And it's no longer mark to market. On the flip side, if the rates continue to increase and the value of your bond continues to suffer and decline, you will see that your mark-to-market losses are ballooning. And because you're doing this daily process of marking to market your positions, you're seeing, oh no, I am losing. So you may want to consider cutting your losses today. If you expect that the trend is that interest rates will continue to go up based on your analysis of news in the markets, and the trend is going to be a consistent upward trend in rates, you may want to consider cutting your losses. And by cutting your losses, that means actually selling the bond. Because remember, mark to market is unrealized. It's just paper losses. So when you sell it today, you will realize the loss. But why would you do that? You do that because your view is that rates will continue to rise. And if you don't sell it today, you will actually potentially make more losses in the future. So you might as well want to cut your losses today. So that's the concept of, that's how mark to market becomes sort of like a cornerstone of risk management. Okay. So there.
Yeah, Clive. So we may add also that for banks, they establish limits, cut loss limits for all traders. So traders will not be allowed to incur so much losses because that will impact the capital of the bank. So it depends on each bank how much losses can they endure. So it's usually the practice is if you're for traders you are given a target on an annual basis. So that is your key result area, or KRA. So for example, you have a budget of 100 million a year. The limit or the cut loss limit is usually about 1 to 2 months equivalent of your annual target. So for this competition, we did not specify any limits because we want you to experience the pain.
Pain talaga.
I mean, then it now we now allow you as a team to set your own limits. Na you set your cut loss limits so that your loss will not run. I mean, it will not continue. Now that we've mentioned about this risk management concept, you can discuss as a team how much losses you are willing to take, and you can set your own limits and observe it. Ayun. If you want to add more, Clive.
Yeah, you can liken your 1 billion pot money as capital of a bank, right? So you have a capital of 1 billion. As a bank, you'll have a capital, for example, of 1 billion. And each and every time that the 1 billion is eaten up because of losses, that's essentially shareholder capital getting eaten up. So that's the reason why, and I thank Chris for mentioning this. That's the reason why banks impose internal stop loss limits. Kumbaga parang banks, the treasury business, the financial markets and trading business is really a risk-taking business. And the shareholders, the board of directors, are cognizant that it is really a risky business. So they allow the banks to take on these risks because there's a potential, obviously, if there's a potential to lose, there's also potential to make money. So as the example of Chris said, her example a while ago was, if you have a 100 million income target or trading gains budget for the year, a bank would decide possibly to have like a stop loss limit that if your losses reach 20 million already, you have to start unwinding your positions before you continue to bleed even further. So again, that's because financial markets and trading is really a risky business. But because there are risks, and that the biggest risk is that these losses will eat up on your capital. There's a need to set these stop loss. So again, it's a good time to, if you're a team that you're already starting to see losses in your portfolio value, your 1 billion is now less than 1 billion, you may want to set, like for example, if arbitrarily, you might want to say, okay, if we see that our losses reach 900, our 1 billion is now down to 800 million portfolio value. Perhaps let's unwind all of our positions so we stop the bleeding. Kasi the 800 million portfolio value might eventually become 500 million, and you would have wiped out half of your capital, quote unquote, right? So that's the beauty about um, uh, monitoring the value of your portfolio daily and revaluing it using mark-to-market methods, similar to what you're seeing here. And that blotter will show you exactly how much is the value of your portfolio, the total portfolio value, relative to when you started the game. So the focus here is to try to increase your portfolio value as much as you can through whatever methods, through interest accrual or through trading actively. And this is actually my last slide. Just to give you an idea, settlement of government securities in the markets uses a process known as delivery versus payment. Now, this is a fancy term for kaliwaan. All right, kaliwaan means I will give you something, you give me cash for it. Or you give me cash, I'll pay you the security. I give you cash, you give me the security, right? And the beauty about delivery versus payment here is there are two legs, obviously. There is a cash settlement leg, and there's a security settlement leg. Because what you are trading here is a security in favor of cash, all right? Now, delivery versus payment means you will not receive the security if you do not give the cash. It has to happen at the same time simultaneously. And because you have different banks that are connected to one another using electronic means, using various bank systems, this allows for an orderly, simultaneous settlement of the cash and the security side. In fact, how do banks settle government securities when they buy or sell? It's done through the DDA. The DDA is an account is a cash account that banks maintain with the central bank. Okay, so banks keep money in that account, and then that's sort of where the money is taken from when you buy a security. Now, the central bank is also connected to the Bureau of the Treasury through another system. Okay, so nangyayari dyan is if I'm a bank and then I buy a security from, for example, let me give a BPI buys from, for example, BDO, a government security. I will have to make sure that I have enough cash in my DDA that I keep with the central bank, and then I instruct my operations team to wire that money from my DDA, which is in the central bank, to the DDA of BDO, which is also with the central bank. And then simultaneously, once the cash is transferred to BDO, BDO will then instruct their operations team to transfer the securities from the NROS account of BDO to the NROS account of BPI. Now, NROS is a registry. This is like a ledger that shows you that is a ledger that shows ownership of a government security. So this is like the master list that the Bureau of the Treasury or the national government has of all of the bond holdings that are of all of the bonds that they've issued in the primary market, and who are the current holders of these bonds that they've issued. So since mangyari dito is since BPI bought a security from BDO, the ownership of this security would have to be transferred in the NROS account of BDO to the NROS account of BPI. And that transfer will happen simultaneously with the transfer of the funds from BPI's DDA account with the BSP to the DDA account of BDO, right? So that's normally how it settles through DVP. Now, there's also the concept of a third-party custodian. These are usually for foreign clients or foreign investors in Philippine government securities. They would have to get a third-party custodian, securities custodian, who will do this transfer of securities on their behalf. Who will do the safekeeping and the execution of the securities and cash settlement for the foreign client. Cash, remember I mentioned that the cash settlement, it's wired. The terminology is called RTGS, real-time gross settlement, because the wiring is done on a real-time basis. And it's done full flow, or meaning gross amounts. Real-time gross settlement is whatever the settlement amount is on the bond that you purchased, that's exactly the amount that must be transferred. So in our case, in the BPI BDO case, BPI must be able to transfer the settlement amount to BDO exactly to the last centavo. if there's like a 1 or 2 cent difference in the amount that is transferred in favor of BDO, this can be a point of contention or dispute. This can actually mean that the trade will fail, and the actual transfer of the security for the cash will not actually take place, right? So that's the beauty about how advancements in technology allow for safer trading between market participants. The biggest risk is actually you sending the cash, BPI sending the cash to BDO, and BDO not transferring the security to BPI. So there's a failed leg. The cash settlement went through, but the security settlement did not push through. That is not possible in the GS markets because of the concept of DVP. An actual trade will be consummated and executed and settled both legs at the same time, both the securities as well as the cash. So that ends today's lecture. I hope this was informative and interesting. I know it's a lot to take in, especially on the part of the valuation side. But I hope this gives you a better picture. I mean, a better appreciation of what the differences are between clean price, settlement amount. This is actual practice. I mean, we learned valuation in school, but again, there are a lot of realities that aren't taken into account. And by using these realities, by adjusting our formulas to reflect reality, I hope that today's lecture has given you a better glimpse of how these realities are actually being applied in practice in valuation. And I hope that the last part of the presentation provides you with the necessary set of tools for you to be able to on a very basic level trade with one another and understand your role. What are you? Are you a calling party or a quoting party? What is the difference between realized gains and mark-to-market gains? With that, I thank you for being a very good audience, and I'm opening the floor to any questions that you may possibly have regarding the presentation.
Don't be shy.
Try, guys.
Okay.
Yeah, by the way, I think we should also emphasize that when you trade, for example, let's do a an example to, Clive. So if I call, so I'll be the calling party. So Clive, how now on 5:15?
5-15, I pay 525. I offer 5.2.
Okay. Notice that I did not say any amount.
Yep.
If I
Yep.
did not say any amount, the assumption is my volume is only 50 million.
Yep.
Okay, but okay, thank you, Clive. How about for 500 million? 515. How now?
Okay, I pay 525, offer 524.
Okay, so he tightened. Um, I'll say okay, mine mine 524.
Okay,
So
we're done.
yeah, to confirm. Okay, so that part we did not say, to confirm, I bought 500 million of 5-15 at 5.24 value T plus 1.
Yep.
Thank you. Okay.
Bye-bye for now. Ayan.
Okay,
So
bye.
ganyan, parang chat siya. So
Hmm.
there, parang chat siya.
So, it is important also to confirm the trade
Oo.
after the quote. Kasi mamaya nagkamali ka na sinabi mo yours but ang ginamit mo palang rate ay yung offer niya. So, para lang to be clear, so you repeat the details of the trade. So, when I said yours, sorry, did I say mine? When I said mine,
Mine.
okay. To confirm, I bought 5-15, 500 million at 5.24 value ton. And then you say thank you. So, there is always pleasantry exchange between the counterparties.
And then me as the seller in this case, I'm gonna say all agreed.
Yeah, so meron na siya.
That's me saying that I agree with your confirmation.
Okay, so we expect you also to practice that. Since you will be using the Bloomberg persistent chat as your trading platform, then we expect you to use the terminologies for traders. Any question?
What we can probably do siguro, Chris, we can give them a sample chat.
Trade.
Yeah,
Okay.
trade chat. Yeah, na showing a buy and the sell, both
Mm.
the calling party and the quoting party. Yep.
Yes. Mm-mm. Hey
Mas-
guys, any questions that you may have, you can put it in the chat box or you can simply unmute. Any question?
Don't be shy. If you don't have any questions, maybe you can share your um, first 2 days experience of trading.
Yes, oo nga.
Yeah.
Sino bang willing mag-share dyan?
Parang parang ayaw nila divulge ng kanilang trading secrets.
Any
Experience lang naman. Don't share any of the details of your trades. You can just simply, ayan, we have a comment from Outsmart. Very exciting. We're learning a lot.
That's good to hear.
And you're gonna learn more.
Yep, for
Mas
sure. You'll be
exciting
learning.
pa yan.
Yep.
any question? Napakalinaw ba? Ang galing mo magturo, Clive. Malinaw naman.
Yes, actually, it's very informative yung lecture ni Clive. Even I was listening and ano naman, parang medyo idiot-proof siya for lack of a better term.
Ito na lang muna. I have a question. Kasi
Oh,
we have a new, if you notice, we have a new sponsor, which is the Philippine Digital Asset Exchange or PDAX. So, si Nichelle, who is the founder of PDAX, has agreed to give lecture on crypto investing or trading if you are interested.
nice.
If that is only if you are interested, then we can have another session we'll have another session on April 27. But if not, then we can do away with that informative lecture. So, it's up to you guys because we only schedule up to April 20, which is on GS valuation. But since Michelle is very willing to impart his knowledge on crypto assets, then he can do the lecture for you if you want. So
Maybe
you have
we can get a consensus na lang from the participants eventually if we're gonna be pushing through with the crypto. I personally would also like to
Yeah,
experience or
ako
learn
din.
more, yeah.
I find that interesting as well.
baka personal lecture na lang yung mangyari sa inyo kung ayaw ng mga estudyante.
Sayang, guys.
Uh, we have another comment. Ayan, would be interested si Outsmart. But prior to that,
Outsmart
may
lang
comment
yun.
din on hindi, may nag-comment din, ma'am, Miss Chris from Baltasar Jude,
Jude.
Prince. I'm Jude. From what team? I'm sorry. Nakakapanibago lang po since we're more exposed to equities. Yes, this is we have to agree. So this is actually kayo yung pioneers into this kind of activity, and you should bragging rights yan, guys, kasi kayo talaga yung una in the many years of Mart, 50 years ang Mart, but this is the first time that this is going to be done amongst students. This activity has been done before, but among young traders, yung mga nagwo-work na, but for students, this is
Ayun pala, interested to learn si Diamond Hands. And just to remind everyone, this learning session is open to your classmates, even those who are not part of the team or not part of the competition. We are opening this up to everybody who is interested to learn.
Our trading views turned upside down. New experience. That's That's
Okay.
precisely why we wanted you to participate. Kasi investing, you'll only really learn if you get your feet wet. That's the
Yes.
reality. If you don't get your feet wet, you're not learning.
Yeah.
Yes. And as Clive mentioned, and as Miss Chris mentioned, we did not set any stop loss limits para you can
Limits.
actually,
Oo.
Yeah.
yes, para bahala kayo.
Okay, so
Maranasan yung
the auction yesterday negatively affected the performance of the market.
rest of the market.
Yes. That's why
Yes,
we
true.
early in the morning we already warned you that there will be an auction that could adversely affect the market. So we gave you that chance to
Mm-mm.
unwind your position. So because this information are available to traders. These are all already available to traders. That's why we shared it to you, because you are tracking you are using the market rate, which will be affected by the movement or the actions of the traders. So that's why on the first um, early in the morning we blasted that to you, so you will be
Mm-hmm.
informed.
Also, we also sent this morning the upcoming auction schedule for the month of April. So take advantage of that information to be able to assess on your next moves.
Right now, since the sentiment is not that it's not that encouraging. So traders are on the sidelines, and during auction they take advantage and submit higher bids. So now it's up to Bureau of Treasury to accept or reject the bids, depending on where they think the rate should be. So next week, the lecture will be the auction process, and we will have the representative from Bureau of Treasury, uh, the 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 issuer itself, to explain the auction process and how they decide to reject or accept bids. So it's very important that you attend that session, and also next week you will be given the orientation or the lecture on how to use the Bloomberg platform. So next week will be it's a very good lecture. Um, may I just encourage you to invite other students to attend, even though they are not part of the competition. Okay. So, any questions on the lecture today? Is it very clear?
Was it too
Anyone?
heavy ba?
Any question? Mm-mm.
Malinaw talaga siguro.
Okay.
Clear po for us. O see, clear talaga. Okay. So now,
Okay.
kung
Okay.
wala nang questions, so Camille, take it
Okay.
away.
Okay, if there are no more questions, going once, twice. Okay,
Sold.
so we're closing the
Wait
session.
lang.
And again,
Nag-raise ng
Clive.
hand. Sorry. Luis Mendoza
Okay,
raised
may
hand.
nag-raise. Sige, go.
Hi, sorry for cutting it so close,
Okay,
but
go
I just
ahead,
want to
Luis.
ask for the Zoom recordings.
Yeah, sure.
Is this online? Like on the Facebook page or something?
Ray, where is it available? I think
Page?
it's being sent to
Yeah.
you. The link is sent to
You
you
can
via
share.
email. Yes.
Yeah,
All
yeah.
right.
All sessions are being recorded.
All right, cool. Thanks.
Yeah. The link is sent to you via email.
Yeah, sa email lang muna.
Okay.
Okay. Any other questions? Kahit hindi related to the topic for now. So, ito na. I'm gonna count again. Once, twice, Okay, you missed your chance. We're gonna be closing this session. And again, Clive, thank you so much for a very informative lecture and again imparting your expertise and knowledge. So, Mart and CFA Society